Thank God. Let's go and let's talk about what this means for the future of trading and how new traders can go ahead and jump into the market a lot easier now. So let's understand what the PDT rule even is. The pattern day trading rule, as defined by the Financial Industry Regulatory Authority, the FINRA, it was a crucial regulation that governed day trading in the United States. Instituted in 2001, it was created to protect inexperienced investors from the substantial risk of frequent leverage trading during the dot-com bubble. So they didn't want people just throwing in all their bread and losing it all for no reason. Okay, when a bunch of new companies were hitting the stock market. Okay, so the pattern day trading rule was pretty much created in order to protect people. So the $25,000 equity requirement. So to be classified as a pattern day trader, okay, PDT, you need to execute 4 or more day trades in a margin account within a 5 business day period. Nowadays, there's 2 types of accounts. You have cash accounts, okay, which lets you trade strictly with your own money. And then there's margin accounts, okay, which lets you trade with some borrowed funds when it comes to the broker. Okay. And once flagged, your account was required to maintain a minimum equity of at least $25,000. And if the balance dropped below this, day trading was then restricted. And what's a day trade in the first place? A day trade was defined as the purchase and sale, or sale and purchase, of the same security within the same trading day. So let's say, for instance, I purchased StackMODE stock for $30 a share, and I sold it for $34 a share within the same day. Let's say I did that all on Monday. Okay, that is a day trade. If I bought StackMODE stock for $60 a share and sold it for $80 a share, okay, and I bought $60 a share on Monday and I sold $80 a share on Friday, okay, then that's not going to be a day trade, because that was days later I sold. I bought on Monday, sold on Friday, not a day trade. But if I buy on Monday, sell on Monday, that's a day trade, okay? So if you buy and sell within the same trading day, that's a day trade. And this rule applies to stocks, options, and ETFs. And the purpose of this rule: the primary goal was investor protection, and the rule ensured that traders engaging in high-risk strategies had sufficient capital to absorb potential losses, thereby protecting both the individual and their brokerage firm from financial instability. So the historic regulatory shift of 2025. So as of September 2025, FINRA's Board of Governors has officially approved amendments to replace the pattern day trading rule. Exciting. This is one of the most significant changes to day trading regulations in over 2 decades. And the move comes as a response to the rapid advancements in trading technology and real-time risk management capabilities of modern brokerage firms. So the fixed threshold is now gone. The rigid $25,000 equity requirement for day traders has been completely eliminated. This removes a major barrier for entry for retail traders. And retail traders, if you ever hear that term, it's just people who just want to get into the market. Okay, not like hedge funds, banks, or anything like that. Just individual investors a lot of the time is what retail means. So individual investors and individual traders with smaller accounts who were previously unable to engage in frequent trading can now do it. So replaced by intraday margin framework. So the old rule is replaced by a more dynamic and flexible intraday margin framework. This new system applies existing maintenance margin rules to a trader's real-time intraday exposure, making it a risk-based approach rather than a capital-based one. And pending SEC approval. While FINRA has approved the change and must still be filed with and formally approved by the U.S. Securities and Exchange Commission, SEC, before it can fully be implemented. So traders should continue to operate under the existing PDT rule until a final effective date is announced. Okay. So FINRA approved the change, and we're still waiting for it to get approved. Implications for traders: a new era. The removal of the PDT rule represents a seismic shift for retail traders, particularly those with smaller capital bases. It promises a more accessible, albeit more complex trading environment. So lower barriers for new traders. So the most immediate and profound impact is the ability for new traders with accounts under $25,000 to execute frequent day trades without restrictions. This democratizes active day trading and opens the door for a new generation of market participants. More dynamic buying power. Under the new framework, buying power will be directly tied to the risk of positions a trader takes, and highly volatile securities or concentrated positions will consume more margin quickly, while stable assets will allow for more leverage. This requires traders to have a better understanding of margin mechanics before you lose all your money and blow your account. And increased importance of risk management. Since the fixed capital floor is now removed, risk management becomes paramount. If you don't follow your rules, if you're not disciplined, if you don't humble yourself, okay, if you don't wake up, pray to God, study the charts, work out, have a strict routine, journal all your trades, you won't be successful, okay? You have to be extremely disciplined when it comes to this game. And it's about keeping up this bread, keeping up getting this money year after year after year. It's not about just making 7 figures in 1 year. It's about doing it again the next year, maybe scaling to 8 figures, 9 figures, and pushing yourself further based off the discipline, consistency. And risk management is going to become paramount, okay? The more power that you have, the more power you're going to have to control. And traders need to be vigilant about their intraday exposure to avoid margin calls or forced liquidations. Forced liquidations is where the market is going to pretty much automatically close your position for you. And if you don't pay the money back that you owe the broker because you're paying with leverage, which means they're giving you capital, then you could be subject to court fees and they could owe you money, or you have to owe them money, okay? So diving deeper into the intraday margin rule. The intraday margin framework is a sophisticated replacement for the outdated PDT rule. Instead of a blanket restriction, it uses real-time metrics to determine a trader's capacity for risk. And here's how it works. So real-time calculations. Brokerage firms will now calculate and enforce maintenance margin requires throughout the day. This provides a more accurate and responsive measure of a trader's risk level. So position-driven leverage. Your trading leverage will no longer be static. It will fluctuate based on the specific positions you hold, their volatility, and the concentration of your portfolio. So for example, a highly volatile tech stock will consume more margin than a blue chip utility stock. And the impact on different strategies. This can make strategies like scalping or fast-paced equity trading more viable for smaller accounts. However, it also introduces a new layer of complexity, requiring traders to understand the specific margin impact of each security they trade. So here's an example scenario, trading under the new rules. So let's consider a practical example of how the new intraday margin framework might work for a trader with a small account. So let's say, for example, Alex, right? Okay, let's use that name for example. Let's say Alex has a trading account with a balance of $5,000. He wants to execute more than 3 day trades in a week, which was previously impossible under the PDT rule. So in the old rule, Alex would only be restricted to 3 day trades. He could not execute a 4th one, regardless of the quality of the signal or his risk management, okay? Because it's 3 trades in a week. Now with this new rule, Alex can now make a 4th, 5th, or even 10th day trade, and his ability is no longer limited by a number of trades, but by the intraday margin available in his account. And his broker monitors his risk in real time. And if he takes a position that's too large or too volatile for his account size, the broker system will simply prevent the trade. So risk and key considerations for traders. While the new framework offers unprecedented freedom, it's not without its own set of risk. Traders must be prepared to adapt their strategies and mindset. You can be subject to intraday margin calls, where unlike the old rule where you were protected by a fixed floor, you may now face intraday margin calls. If your positions move against you, this requires immediate action and could lead to forced liquidations. And education is going to be paramount. Understanding concepts like maintenance, margin, concentration limits, and intraday exposure is now a non-negotiable part of a day trader's playbook, and a lack of knowledge could lead to significant losses. And firm-specific rules. While FINRA sets the regulatory minimums, individual brokerage firms are free to impose stricter rules, and traders must be aware of their broker's specific policies, as these can vary significantly. And the removal of the 25,000 PDT rule, it's really just a monumental step towards monetizing day trading for brokers so they can make more money. And it's a monumental step towards modernizing day trade regulations, making it more accessible for everybody. Okay, so God is good. It's an opportunity for you to come on the charts and make some money just by being disciplined. Make sure you get informed. Head over to StackMODE for all trading education. And this rule is going to make trading more accessible. Okay, it's going to bring more volume to the market. More people are going to start trading, inshallah. Okay, and it's also going to come with an increased amount of responsibility. With more power comes more responsibility. Okay, love you guys so much. Stay prayed up with God. I'll catch you in the next one. Keep grinding. Peace.